the monetary policy questions with the HDFC Bank 81 capital raise, $1 billion, 3.7, good outing in terms of raising money from the offshore markets?
Yeah, fantastic result, I think. 3.7 is an extremely good rate. 1 billion is a very good amount. We don't have too many banks who have raised in the region also. There's this amount at this rate. I am told that we've not seen any bank of this rating, the issue rating which we had, BA3 by Moody's, raise 81 at this low coupon. We are possibly the lowest coupon this year globally. So extremely good result. So it was good.
What was the sentiment from the investors? Was this a combination of the liquidity conditions, the fact that India credit from banks may not be that up for offer that often, plus of course HDFC Bank being the largest private bank in India? Combination of those led to the strong demand.
Yeah, all put. So obviously there's liquidity, rates are low, people are looking for yield. That's one. Supply from India and especially Indian banks and has been on the lower side over the last 2 years. So that was one part. But to get the amount at that rate, I think is just tells us how investors view HDFC Bank. HDFC Bank, its credit, its financials. If you see, one of the they look at what's the credit outlook and what has been the credit history. If you see our GNPAs, 30th June, 1.47%, total coverage ratio, 146%. So, very, investors are very, very comfortable with the credit quality of HDFC Bank. What are investors worried on 81, right? Will the bank be in a position to call the bank bonds back after 5 years? They have to assess that, right? No bank can guarantee that they call back. So they look at the capital. Now, how has the bank done on capital? Capital adequacy ratios for HDFC Bank have always been high. As of June 30th, our capital adequacy was 19.1. The CET1, the core equity, was at 17.2. And the trigger for writing down the 81 is 6.125. There's a gap of around 11% odd between the write down trigger and the actual capital we had, CET1 we had. So again, very comfortable. The next thing they worry about is whether the bank will be able to pay coupons or not whenever they are due. Where does the bank pay coupon from? From profits, right? HDFC Bank has been consistently profitable quarter on quarter, never really lost. We are the most profitable bank in the country. So all that gives so much of comfort. So we saw excellent investor response. Now books were oversubscribed in initial price guidance by 4 odd times. Even when we tightened the price by 42 odd basis points, the books were still oversubscribed by more than 3 times. So and all good investors, real money, long-term investors were happy to take these bonds. So extremely good result for us.
That's great. And, I presume other banks will now be looking to do the same. But Ashish, just one more question on this. Is the option to raise in the local market more or less non-existent, especially if you're raising in large amounts?
No, I won't say non-existent. Obviously, the market is not as liquid as it would be, say, 2 years back, even though rates are low because, the valuation norms and other, restrictions imposed by SEBI on mutual funds. So they're not that liquid. And, for whatever reason, there are certain set of investors who are okay to invest in public sector 81s, but not private sector. So for our private sector banks, it's even less liquid. We can raise, but yeah, at one go, this kind of amount I think today for any bank today will be extremely correct. Over a period of time, you give it 3 months, 6 months, 1 year, we could raise, in small tranches amounts. Still, it is attractive, but maybe the rate in the domestic market might be slightly lower than what the overseas cost us. But I think we need diversified market sources for our capital. So that was another reason why we went overseas.
Okay, got it. Ashish, allow me to transition into the broader conversation around what's happening on monetary policy and the economy in India. So I think we got some hint that there is conversation about normalization happening in the latest MPC minutes in particular. Do you think we are at the point where we need to now start moving towards that normalization? I think one view in the MPC still is it's too early. We are still not sure about growth, but an emerging second view is that it's time. Which side do you weigh on?
I would go with the fact that it's too early. So no, let us look at the context. I think we get vitiated by what is recent numbers, etc., etc. But if we go back to pre-pandemic, pre-COVID, Indian economy was growing a certain pace, but still slowing down. Everyone was talking about how can we move faster, and then this pandemic hit. And suddenly, there was a drop in GDP. Now, if you pre-pandemic, there was a certain nominal GDP, there was certain aggregate demand, and there was supply, and inflation was not that great a concern. Suddenly, bring down the GDP by a large amount. Say the supply side remains similar; it could be disrupted. The aggregate demand has come down. So, from that perspective, fear of large-scale inflation, I don't think is correct, right? We still have the, come down the growth path significantly. There has been a shift, right? The downward shift. We still need to catch up with the growth. And so I think, it's still too early to go back to any normal policy, right? And I'm saying normal, even if we were to go back to normal, it would be a very accommodative normal policy. I wouldn't say. What possibly is the question is, we are now into a super accommodative policy. When do we correct it? I think we need to see that everyone needs to be comfortable with a sustained growth, coming through in a quarter on quarter and forecasted quarter on quarter. We still don't know. Only then we can, maybe correct a bit of the super accommodative monetary policy. I think that's where, I would put it. I think, I would want to go further to say, see, we have seen unusual years. So, right, lot of numbers look different because of base effects. Right? They've been volatile. Suddenly one comes down, then base effect, the next year looks very good, and then again you may not see those numbers, whether it be growth or inflation. What we need to watch is sequential momentum. So whether it be growth or inflation, is the sequential momentum trending upward of inflation, sequential momentum flat, sequential momentum going down? Should we be worried? I think that's more we should look at those kind of numbers rather than just look at YOY and say, because the base has been very volatile across 2 years.
True. Like you said, Ashish, I think we are a distance away from normal, but perhaps the question is, how do you start grading yourself away from this super accommodation, right? At this point, we are, I think, 11.5 lakh crore in surplus liquidity if you add the central's balances with the central bank. Now, is it correct to assume that none of this liquidity is going to be inflationary? I mean, yes, I know credit demand is not there right now, but as the COVID environment settles, if the third wave is not as disruptive, don't you think we will start to see those impulses? So isn't this the time where you have to at least start taking some steps to normalize that liquidity, which will take years, I'm sure. You can't take away 11.5 lakh crore surplus in, a year.
No, agree with you that somewhere, see, some liquidity creation has been deliberate, some has happened because of various flows, so we have to keep that in mind. I think the first step is the most difficult, right? First step is you take when you are extremely sure. Again, today we are saying we don't know whether the third wave will happen or not, whether how big or small will it be, what will it do to aggregate demand. So I would say, why won't you want to see what happens and then take the steps? Because you start now, you are saying that I am reasonably certain. The first step will then send signals very clearly that the super accommodative policy is going away, right? And you can only change if you are extremely certain of the. I won't say no, you can't be sure of 3 years hence, but you can always be sure of what's going to happen 4 quarters, looking forward. And we need to see sustained growth for those 4 quarters sitting here today. And only then we can say maybe it's time to, take steps away from a super accommodative monetary policy. And I think this is the dilemma central banks all over the globe are facing. It's not just India. Everywhere it's the same thing. When should we start doing something about the super, accommodative policy?
What would be, according to you, the sequencing of normalization, and to what extent do you see these, VRRR, the variable reverse repo rate auctions, as a baby step towards that?
So yes, see, I would say that the VRRR is actually not a baby step towards normalization. I would say it is a more step to ensure that the current super accommodative policy doesn't become more accommodative, right? So that is what has been happening. So because of 11 lakh, it's not what is desired or possibly what is the objective, and that's why the rates today in the market are lower than the reverse repo rate, whether you take CPs, CDs, etc. So I don't think that is by design, right? So the first step to a VRRR is to ensure that the reverse repo is the base. I think that's the bigger challenge. That's why it's VRRR. I think obviously to ensure that, I would say that it would be a increase in amounts of RRR. That's the immediate way to go. And when we want to come out of the super accommodative monetary policy, obviously then a slow move up in the reverse repo rates towards the policy rate. Policy rate is way away, and I think we will see some corrections because the way it's going slowly and steadily. But first, they have to ensure that the reverse repo is the effective policy rate. As of today, I think you see markets lower than that. So that's a challenge.
How quickly are you internally building in a move in the reverse repo rate?
My personal view, I don't think we've discussed it too much internally. I don't think it's happening this calendar year, if at all. We will see, because third wave, etc., is somewhere this September, October types. So that is forecasted, right? Through the festival season with good growth, with aggregate demand. Government has still not started its expenditure in a full way. If the third wave doesn't come, everything is normal, I'm sure they will do that. So that's the time when everything is there are other stimulus to the economy where you possibly see a correction of the reverse repo rate. Can happen towards the end of this calendar year also, if everything goes well through the festive season. Then the third wave is I think very mild, or at the economy.
Ashish, I'm just curious, this sort of surplus liquidity that's sloshing around, apart from the low CP and CD rates, is there any other sign that this is leading to distortions in other parts of the market, which the RBI may get worried about at some stage?
Not really, have not come across that. In fact, if you see, the bond is quite steep, so it's really not leading to distortions there at all. It's only extreme shorthand, because see, everyone is anticipating that somewhere this will get corrected.
Yeah.
It's already there in the market, right? Otherwise, you shouldn't have seen bond yields or the curve so steep. Everyone is anticipating. So from that perspective, it is good, right? There is an anticipation. Market is already anticipating somewhere there will be a correction. So the impact of the correction may not be adverse, in terms of impacting growth or actions of market participants. So,
Ashish, what do you think about how long we need to continue with GSAP? In some ways, it's contradictory because we have such surplus liquidity, yet there seems to be a need to support the government borrowing program. Do you think firstly, how long do you think we need to continue with it, and what will be the market's reaction if the RBI starts to wind it down?
So what I say, my view here is that the RBI has done a lot in GSAP, managed the yields very well, and also slowly allowed the yield curve to find its maybe yield where it can possibly is in equilibrium. I think the liquidity is so much today that even if RBI were to slow down GSAP, I don't think the yield curve will go up much. The liquidity will start, pressurizing market participants, whether it be banks or otherwise, to build upon bonds. Credit growth is still anemic, right? That growth is reasonably anemic, and it will take some time for that to happen. So I think maybe third quarter onwards, etc. Maybe there could be some moderation in GSAP because we've had a successful borrowing program without too much of impact on yields. The remaining portion is lower in terms of borrowing. Liquidity is large, and there could be other. And government has really not. Won't possibly doesn't look to have the need of exceeding the borrowing program. So they have managed everything so well. So I think maybe we will see lower GSAP need. In fact, yield may not go up if there are no GSAP. Maybe the wind down will be again phased out. It won't be suddenly there's no GSAP, but it's lower. They may not need to do that, and the yields might stay where they are.
Sure. So long-term rates right now, you think are reflective of the reality? I think there was a lot of furor over the last few months that rates are being kept artificially low because of GSAP and all the stuff that was happening at the auctions. Now they've moved up towards about 625. Are they more or less reflective of what market conditions and the economic conditions would justify?
I think so, more or less. Because what I read from even if you read the monetary MPC minutes, etc. I don't think anybody's talking about changing 4. Right? 4 is they're only talking about maybe excess liquidity or changing the reverse repo rate. So I think at 4, 6.25 on the 10-year is not unfairly priced. Right? It could be here and there, 25 basis point, 50 basis point at best. But I'm just saying it is not unfairly priced. It's priced reasonably well, and especially if the economy were to pick up and the government revenues were to pick up. I think they have been extremely strong till now, till July, whatever the numbers have come out. So and they don't need to exceed borrowing programs, and so I think it's reasonably fairly priced, I would say.
Ashish, a slightly longer term question. If one zooms out and looks at what's happened now to the policy rate, which theoretically is still the repo rate, over a 2.5 year period, we've seen a sharp fall, and now we're going to see a very extended pause in the repo rate at a very low level, 4%. Now, the previous time we had seen something like this was perhaps in the Jalan era. That time we saw a big boost to investment. This time the conditions will probably not allow us to have the best impact of a low and stable interest rate regime. Am I right in thinking that way?
So, the point is, we will see. It's not that we are not seeing investments. We are seeing investments. You can see the FDI numbers, etc., etc. Yeah, we are not seeing investments what we used to see before. Large manufacturing plants, maybe in the core sector, etc. Maybe that's not required, right? At this point in time. At some point in time, it may be required, but not at this point in time. So there are investments in digital. There's investments in infrastructure. There's investments in logistics. Those things, maybe smaller amounts are required, but I think that's where you will see investments coming in. And I think, and all the more reason that if we are not going to see a big set of investments, we are not going to see a big, pick up in aggregate demand, rates can stay lower for a much, much longer time than they could stay before.
True. And one benefit, I guess, has been the deleveraging cycle. That's certainly been one benefit of the liquidity and the rate scenario.
Definitely. So, so corporate balance sheets have become much, much stronger. So if there is need for capex, they are in a position to do it. The rates and the liquidity allow them to do it. So I think we're in a good shape for a start of an investment cycle. But even now, whatever one reads is like even now the existing large manufacturing capacity utilization, obviously we vary from industry to industry, is around 65-70%. So it's not, completely utilized where it will spur investments in a big way. So I think the investment will continue to be driven, led by public and public sector, because it's going to be infra, it has to be in health, it has to be in education, where, maybe private sector revenue models don't exist for the final delivery, but they will be private sector suppliers to the entire infra build up. So I think that's how things will move.
Ashish, last couple of questions on the global front. I think everyone is now awaiting understanding of how quickly taper will come from the US Federal Reserve. What's your sense of how the Indian ecosystem reacts to it? I think the point has been made time and again that we're not in a 2013 kind of scenario. So while volatility may be inescapable, but it may be slightly more short-lived.
I would agree with that. See, one, of course, it's not 2013. And, all the markets now have seen the behavior of central banks, right? Whether globally or, if things start going wrong, they quickly pause, right? Any correction of the super accommodative policy. So that's what would be expected. And even US would be extremely, careful in terms and measured in terms of how they, move towards a petty, more normal policy, I would say, because again, everywhere growth is a big concern. Employment remains a big concern. While the numbers look good in the US, but again, there's always a debate about permanent versus temporary employment. Have actually the real wages grown, and whether people have enough savings to take care of the future. So all those things are there. So I think it will be a very extremely slow, measured move. And every central bank would want to see growth, sustainable growth. It can't, so I think the message is the same. I don't see that changing significantly in the immediate short term. If, next 12 months, if there's a global boom, I don't think anybody would mind rates going up.
Okay. Ashish, we've also kept a very tight leash on our currency. I mean, back in the day, we used to talk a lot more about the currency markets than we do today because the central bank has just kept a really tight leash. You're comfortable with the way sort of the currency management environment in India has progressed?
See, I think currency management in India has been very consistent. I have not, there, in terms of, how much intervention is there, or otherwise there could be differences there. But it's very interesting because a lot of flows into India may not be permanent flows. We are a current account deficit country. So obviously there's a permanent outflow from that perspective, right? It is definitely an outflow. Then you have capital flows too. And a significant proportion of those capital flows were portfolio and debt flows, less of FDI. So obviously, the central bank has to have enough reserves to, take care of those outflows if and when they happen. That's what happened in 2013. We are in a much stronger position to today if the outflows were to happen. Definitely that will create volatility. But I think this, and it's been very consistent. Build up reserves, take care of non-temporary flows which are coming in, and so it is, and keep the currency competitive. Not it's not extraordinary competitive. It's not, but you cannot make it uncompetitive completely, right? So that's the objective, because the temporary flows make it uncompetitive, which may not sustain in the long. So I think it's been very good. It has always been slightly more asymmetric in the sense, more aggressive when buying, less aggressive when you're selling. But that's the nature of our current account and our balance of payments. So I think we have to. That's how they
All right, Ashish.
Manage the currency.
Ashish, I'll leave it there. Thank you so much for sharing your views on all things economy and markets. Appreciate you taking the time to speak to us here.
Thank you, Raj. Thank you once again for having me over. It's been some time, so thanks a lot.
Thank you. Thanks for watching.